My name is Jojo Dueso. I'm going to be talking about 15 different companies and different industries. And my first company is going to be Entergy Corp. I'm going to focus on asset management, profitability, short and long term solvency. And to start with, we looked at the company's ratios within a span of 5 years, meaning 2008 to 2012. And the ROE for Entergy has been was stable till about 2011, where it went down to 9.3254 in 2012, and the ROA was relatively the same till about the same time, and asset turnover was about the same till about 2011. And I'll get to talk more a little bit about what the company should have done or can do to avoid low ROE and ROA. And cash ratio and quick ratio were both low by industry level. The current ratio has relatively been doing good for Entergy, and it's back up to 0.8969. Leverage was down and it's back up to 4.6207, and debt to equity was moving up as well. I'm going to go over and talk about just how this kind of affected the company. I feel the quick cash position still seem pretty weak, and managers may want to try to find ways to move highly liquid assets to cash and near cash accounts. Though the current ratio has improved, the best way to increase liquidity would probably to work more on profits and sales. Sales went down by 8.26%, and I think that's what affected the profits in 2012, and that's why all the ratios were kind of down. And during this period, debt was added, but the profitability level was falling down. So generally, when you increase debt, and you want to use debt to magnify gains, you don't want to use debt to magnify your losses, because it kind of brings out your losses a little too much. There was moderate amount of debt on hand as measured in debt to equity ratio, yet it's not reporting any net interest expense. By that I mean there wasn't any interest expense on hand despite the amount of debt that was available. So the negative trend in this area could suggest that there will probably interest charges on some of that will be accrued in the future in case the debt structure is not reviewed. The ROA and ROE have reduced, and that's just not good for creditors and owners and stockholders who put their money in expecting returns. I will go forward and talk about the supply chain. Entergy is self-sufficient in that it builds most of its equipment, most of its assets are manufactured within, and it only has 3 suppliers, mainly Kansas City Systems and 2 other suppliers. So that kind of allows the company to have a good hold in terms of its equipment and asset base. We're going to look at weighted average capital to look at the economic value added for Entergy, and it's a negative 507.41, and that just shows that the company's financial performance based on residual wealth was a little low, and it went towards a negative trend, and the value added basically is not helping out the company. It's basically a measure of a company's financial performance based on the residual wealth calculated by deducting cost of capital from its operating profit, adjusted for taxes on a cash basis. So it kind of tends to be a good sign to look at, the profitability of a company from an investor's point of view. The next company I'm going to look at is Exelon Corp, and we're going to look at the ratios beginning with the liquidity aspect of it. Much of the firm's liquidity continues to be held in a non-cash asset, and that becomes a bit more difficult to turn into cash, and that's probably why the current assets current ratio is higher compared to the quick and cash ratio, and the company should probably consider shifting the liquidity base from liquid assets. Shifting their liquidity base to liquid assets such as cash and overall short-term solvency. ROA and ROE have decreased over the past 2 years, partly as a result of low profits. And we can see that the debt and debt to common equity ratio is relatively low compared to the industry benchmark. And again, we tend to come up with the idea that there's a lot of cash balances that have earned interest, and that could be why the interest coverage ratio is artificially low too for that period. The next company I'm going to look at is Fast Energy Corp, and they don't have sufficient amount of current assets as compared to short-term liabilities. This is reflected by the company's low current ratio. Low cash ratio shows that there are not enough resources invested specifically in the cash accounts. Relative to the industry, the company currently has a slightly higher amount of debt compared to equity. Low ROA and asset turnover could mean the company is not driving enough profits or revenue through its asset base. Therefore, despite the moderately low scores, there is still some room for improvement. Fast Energy Corp has a positive economic value added of 266.72, which just shows the company's residual capital structure had a good performance. American Electric Power liquidity ratios are poor compared to the competition. There are not enough resources invested specifically in the cash and near cash accounts, and over long run poor liquidity kind of results in managers taking time off of what they're supposed to do, which is run the business and focus on ways to make more cash, and that kind of slows down the aspect of growth of the business. Overall efficiency of debt has improved overall, but there's no correlation between profitability and debt. The drop in profit margin, asset turnover, and ROA could mean probably mismanagement of the sales dollars, or that the company just could not generate enough of returns for both shareholders and creditors. The company definitely seems to have high inventory days, which just means that they're taking a long time turning that inventory to cash. OGE also has a weak liquidity, and that just shows that they'll have a difficult time paying their bills on time and managing cash flow, and the fact that there's no cash on hand to deal with unforeseen negative economic occurrences. The company is earning healthy profits as shown by the increase in profit margin. In 2012, the profit margin was much higher than the margins of the industry competitors. Sales seem to have increased, but gross profits have fallen. This could mean it costs the company more indirect costs for each sale dollar generated, thus not bringing in enough money for shareholders and not bringing in enough profit. And that kind of shows that the company generally relied on leverage to drive income performance. In the utility industry, I picked Entergy because it's well positioned geographically and it's diverse in the mix of its regulated side of things and its merchant operations. The company is also focused more on maximizing shareholder value, and that allows for a steady investment of rate-based growth, as well as its ongoing stock buyback program and incremental dividend. I used Excel to and basically variance in Excel to come up with the forecast price of what I think the stock price would be in 2014, and it's I have a graph to show that, and it's has a consensus of what my calculations would have shown in 2010 and 2011. It's a little off, but it is what I tried to come up with.